Bismillahirrahmanirrahim. Assalamu alaikum. I am Ubaid Laghari, student of Business Administration Department, based BB2K17, Sindh University Campus, Larkana. Today we are going to discuss about the most important topics that are related with the corporate finance. So today we will discuss and describe the concept of financial statement analysis and why it is necessary to analyze the financial statements. Another topic we have accounting profit, the concept of accounting profit and how can we calculate accounting profit. The third topic we have economic profit and how can we calculate economic profit. And the last topic is trend ratio analysis and the purpose of trend ratio analysis. So starting the lecture with a brief definition of corporate finance, that what corporate finance is. Simply, the corporate finance is the study of financial decision making taken by the financial managers in order to maximize the capital as well as to maximize the profit of the company. There are two main decisions are taken by the financial managers in the corporate finance. First is investment decision, second is financing decision. However, the main purpose behind taking these two decisions in order to maximize the capital of the company as well as to increase the profit of the company by investment opportunities as well as financing opportunities. So this is the simple concept of corporate finance. So let's talk about the financial statement analysis. So first of all, let's talk about the financial statements. So financial statements, there are four financial statements: balance sheet, income statement, statement of cash flow and statement of owner's equity. These four financial statements can provide the useful and most effective information related to their whole financial structure and the whole financial data. The balance sheet can show the what company has earned the assets as well as what company has a liability, as well as we can say that the balance sheet shows the financial position of the company in particular time period. If we talk about the income statement, the income statement can provide them information about the expenses, about the revenue, that what expenses they have utilized and what revenue they have generated. And the cash flow statement, we can say the what the finance is inflowing and outflowing. The cash flow statement shows the inflowing and outflowing of the cash. If we talk about the statement of owner's equity, you can say the statement of retained earning, that the amount that has been reinvested in the business. So if we talk about the simple concept of financial statement analysis, so the financial statement analysis is the systematic process of examining the financial structure as well as we can say the financial data in order to accumulate, in order to get the most effective information for decision making. So the financial managers are the key persons who take the responsibility. They review and analyze their financial statement, and after that they can take easily decision. So if we talk about the purpose of analysis of financial statement, so first purpose is to take decision making about the financial structure, that what they have earned, what they have lost, what is the current position of the business. And the second purpose is compare the result with the present and the past, that what they have earned in past and what is the current position, in the past, what they have earned, what they have lost, in the present, what they have earned, what they have lost. So the second purpose is compare the result of past and present. And the third is maintain the market competition. So this was the concept of financial statement analysis and the simple definition of corporate finance. So we have another topic, that is accounting profit and how can we calculate accounting profit. So simply, the accounting profit refers that amount of money that is remaining after deducting the explicit cost from the revenue that has been earned by the different sources in a specific time period. If we talk about the explicit cost, it means such a type of cost which has been used in order to complete the business operations. We can say the expenses that has been utilized in order to generate the revenue. So say suppose if the company has earned $1,000 as a revenue and they have expenses of 500. So applying this formula we can calculate accounting profit. Now we have to deduct the explicit cost from the revenue. So here 1000 is revenue and we have explicit cost of 500. So when we deduct 500 from 1000, the answer will come 500. Now the 500, this is the accounting profit. We can say the net income that has been earned after deducting the explicit cost from revenue. So the third topic is economic profit, that how can we calculate economic profit. So the economic profit simply refers that amount of money that is remaining after deducting the explicit cost as well as implicit cost from the total revenue that has been generated from the different sources. The economic profit is totally different from the accounting profit. In the accounting profit, we just deducted the explicit cost from the total revenue. But in economic profit, we have to deduct the explicit cost as well as implicit cost from the total revenue. It is not necessary to follow the accounting principles. Economic profit follows the economic principles. So the formula of calculating economic profit is we have to deduct the explicit cost as well as implicit cost from the total revenue. Say suppose if the company has earned $1,000 as a revenue and they have 300 is explicit cost and 200 is implicit cost. When we deduct, so 1000 is our revenue and we have to deduct the explicit cost, that is 300, as well as we have to also deduct the implicit cost, that is 200. So when we deduct the 200 as well as 300 from 1000, the answer will come 500. Now the 500 will be our economic profit. So the key difference between accounting profit and economic profit is that accounting profit can be calculated by just deducting the explicit cost from the total revenue that has been earned in a specific time period, while economic profit can be calculated by deducting the both implicit as well as the explicit cost from the total revenue that has been earned in a specific time period. So another difference, accounting profit follows the generally accepted accounting principles, while economic profit can be follow the economic principles. And if we talk about the implicit cost, it is the cost that does not require any outflow of cash due to the own resources, means the cash does not paid because of the own resources of the owners. And so example of accounting profit, say suppose if the company has earned $1,000 in the month of June as a revenue and they have explicit cost of 500. So when we deduct the explicit cost from the total revenue, the answer will come 500. Now this 500 will be accounting profit. Accounting profit, we can say the net income that has been generated after deducting the explicit cost from the total revenue, while economic profit can be calculated by deducting the implicit cost as well as explicit cost. Say suppose if the company has earned $1,000 as a revenue in the month of August and they have explicit cost of 200 and implicit cost of 300. So the formula of calculating economic profit is that we have to deduct the explicit cost and implicit cost from total revenue, while we have 1000 as revenue and 200 as explicit cost and 300 is the implicit cost. When we deduct the 200 and 300 from 1000, the answer will come 500. So 500 will be economic profit. So the fourth and last topic is trend ratio analysis, as well as the calculation of trend ratio analysis and the purpose of trend ratio analysis. So if we talk about the particular word trend, it means momentum of price. We can say the statistical graph which represent momentum of price due to changes in the market. If we talk about the trend ratio analysis, so it is a technical idea which is used to predict the future event that could be happen in the coming time based on the past data, based on the past information, based on the past assumptions that can be predict the future outcome that the events could be happen in coming time. So if we talk about the calculation of trend ratio analysis, so here is the formula of trend ratio analysis. So we have to divide the current amount with a base amount, and then we have to multiply, then the whatever answer is coming, that would be our trend ratio analysis. So here we have taken the data of 4 years from 2010 to 2014. So the base year we have taken is 2010. We have $200,000 and we have to find the current ratio amount. So the current amount the current amount will be 2012, that is $1,500. So according to the formula, current year amount is 1500 and we have to divide with base year amount, that is 2000. And when we multiply with 100, the answer will come 75. So the 75 will be trend ratio of 2011. Now we can calculate the 2012 in the same way. In the 2012 we have amount of 1000 divided by base year amount, which will be same as 2000 and multiplied by 100. The answer will be 50. Again 2013, we have amount 1200 divided by same base amount multiplied by 100. The answer will come 60%. Again the last year 2014, we have amount 1400 divided by base year multiplied by 100. Whatever the answer is coming will be the ratio of 2014. So if we talk about the purpose of analysis of trend ratio, so we can predict the future based on the present data. So we can show the statistical graph and can predict the future outcome by showing this graph. We can predict the events that could be happen in a future. The second purpose is to compare the market situation as well as the momentum of price due to the changes in market. So this was all over about the concept of financial statement analysis, as well as the accounting profit and economic profit, as well as the trend ratio analysis. Thank you.